Let me just repeat that. Today's report has the unemployment rate down to 4.8%, a significant improvement from when I took office and a sign that our recovery is moving forward, even in the face of a COVID pandemic. In September, we saw one of the largest increases in average wages paid to workers, working Americans on record.
Ooh, what's going on, my fellow stock market and crypto freaks? Your boy Kevin. Welcome back to the stock market today. The stock market took another elephant-sized dookie today. As we woke up, the market was gapping up pre-market. Everything was looking good once again. We came off a pretty decent day yesterday just to have the bell ring and the market to jump off of a cliff head first. Just complete rollover, giving back most of the move. Now we are back at those lows that we saw the other day. So we're going to look at the overall market and take a look at exactly what's going on. Also, we have Cathie Wood of Ark Invest firing back, shots fired at the short sellers who have been saying that her funds are in a big giant bubble. So we're going to look at the popular Ark Invest funds and talk about whether they are indeed in a bubble or is this just a buying opportunity. We also have Morningstar, one of the biggest analyst firms out there, coming out and saying that Tesla stock is overvalued by as much as 60 or 70%, giving it a fair market value of just $680. And to wrap things up, we're going to talk about how the rules of the game have changed forever. The Rona, the pandemic have changed the rules of the game, talking about the stock market, and it is changed forever. And if we don't adapt to it and change the way we value companies and value stocks, we're going to be left behind, sitting there, getting dust blown in our face. All right, so we're looking at the SPYs. We got the SPY chart pulled up on the screen. And if we back off to a daily chart, this move is fun. Finally, we have some volatility back in the market. It's just not every day you get a 0.2% move higher. You wake up, same thing every day, just that grind higher. It's much easier to make money in the stock market when there's volatility, and all this volume and volatility that we have seen over the last couple of days is opportunity. But if we look at this move, started the day after Thanksgiving with the sell-off, and we have been chopping around volatile since then. But yesterday, we had a really nice day yesterday, closing up near the highs. We gap up this morning, go to a 5-minute chart. Everything's looking good, and then boom, the bell rings, and we get one of these, just a complete rollover. No buy pressure whatsoever, and right now, we are bouncing a little bit, but it's going to take some serious buying coming into this to get back up there towards those recent highs. Investors had their eyes on the jobs report that came out today, and it was a giant miss with a gain of just 210,000 jobs. We were expecting a good jobs report. Obviously, if the market's trading up at these levels, all-time highs, you're driving down the highway at 200 miles per hour, you can't make any mistakes, right? If you're going down the highway 50 miles per hour, you can pull up Pornhub on your phone and watch your favorite performer do their thing. You know what I'm saying? You have room for error. You can text your girl, text mama, tell grandma to put some cookies in the oven, and no big deal. Maybe it's illegal in your state to text and drive, but you're probably not going to wreck if you're just going, 40, 50, and you're taking it easy. But if you're going 200 miles per hour down the highway, there's no room for error, right? You hit the smallest speed bump, you're flipping that car, and you're totaling it. That's what we're looking at right now with the market trading at this price point. There is no room to hit a speed bump. You hit a speed bump up here, it's game over, you're going to have a correction. And we're seeing that right now with the Omicron variant. It probably isn't even as bad as the Delta was, right? From all data that I'm seeing initially, it may not be as severe from a symptom standpoint as the original couple of variants. But we're trading so high that any bad news can result in a pretty significant negative sell-off. Also, we see it with the jobs report. It's probably not the worst jobs report in the world, but when you're trading at these levels, there's no room for mistakes. All right, so the non-farm payroll increased by 210,000 jobs in November, following a gain of 546,000 jobs the previous month. So it was pretty much slashed in half. The number was well below Wall Street expectations of 573,000 jobs. Despite the big miss, the unemployment rate fell to 4.2%, a 0.4 percentage point decline. So the unemployment rate is still slowly dropping, but when we're not adding these jobs, it is pretty scary stuff. Professional and business services and transportation led the gains, while hiring in leisure and hospitality was sluggish, and retail lost jobs despite the traditional holiday season hiring. All right, this is not a good sign, folks. This is not a good sign. We have the supply chain crap going on, the shortages and all that, and that's probably why you see transportation and warehouse leading the gains. Then you have leisure and hospitality. Who's going to go work in a restaurant making $15 an hour waiting tables when you have the opportunity to still collect unemployment? You have the opportunity to still get money via these social safety nets. Nobody's going to do that. It makes no sense to go work for less than you can make sitting at home. And until these just social money welfare programs are put into check, we're not going to see businesses able to hire like they should be able to do. And it's going to hurt the economy, and it's going to hurt the stock market. Also, what's going on with the holiday season hiring? Christmas is a month away. We should see these retail stores being able to hire, and it's not the case. Do I think the market is just going to crash and roll over within the next couple of weeks? Probably not, and here's why. Number one, everybody thinks the market's going to crash right now. Everybody thinks that the stock market is overvalued. And when everybody is on one side of a trade, I want to be on the other side of that trade. Most retail traders lose money, and if everybody's trying to pick short-term direction, I want to be on the other side of it. Now, I do think the market is a little bit expensive up here, but I'm not going to be jumping to step in front of this moving train from a directional standpoint. What I'll be looking for is the market to chop around and this volatility to die down, and then I'll consider a directional trade, but I'm not going to spend tons of money on some options contracts that are way overpriced because the volatility has picked up a little bit. Also, I think the rules of the game have been changed forever. And Cathie Wood is a prime example of this. She has been getting a lot of negative media over the last couple of weeks with her funds, people calling them bubble funds. She does own a lot of speculative growth stocks. But think about the innovation that we're seeing over the last couple of years, right? We're at an inflection point with innovation. If 2 or 3 years ago, you told me that a company like Facebook, a big multi-billion, almost trillion-dollar company, right, is changing their stock ticker, changing their entire business model to adapt to innovation and get involved in the metaverse, I would have told you were nuts, that you need to get it checked into the psych ward, you needed a gown with your ass hanging out the back because you were Looney Tunes. But now we are seeing this innovation just absolutely take over, and who knows what the true value of these companies are, because the tech that they're spitting out is like nothing we've ever seen before. So Cathie Wood fired back. She said, your stocks may be in a bubble, but mine aren't. She goes on to say that she actually thinks the big blue chip benchmark stocks are more so in a bubble versus tech. And I tend to agree. I think tech has dragged these old school blue chip stocks up with it. All right, so how about Tesla stock? Morningstar came out a couple weeks ago and said that Tesla stock is overvalued by more than 50% and has a fair market value of $680 per share. Right now, we're trading at about, we'll call it $1,000 a share. $680 is way the hell down here. What Morningstar and these short sellers that have been so wrong with Tesla, what they get wrong is that, sure, There's no money in selling cars. I absolutely agree with that. And that's why I haven't gone out and bought Rivian. I haven't gone out and bought Lucid Motors. And I'm staying away from the traditional auto manufacturers. It's very hard to make money selling cars. The margins are razor thin. Tesla is not a car manufacturer. Everybody has been screaming it from the mountaintops, trying to tell these short sellers what the deal is, but they never listen, and they always get burned. And I think Morningstar is also going to get burned. Why is Tesla not an auto manufacturer? This is why. Solar. Solar is one of my favorite sectors. I've said it 100 times. I'll say it 100 more times. Think about the entire power grid, not only in the US, but around the world. And then think about making it all self-contained, individual residents having a self-contained power system, just wiping these local municipality power grids off the map. Georgia Power, where I live, in these local counties, these rural counties, have their own EMCs. Think about just wiping those off the map and how much revenue that could bring a company like Tesla. And it will become cheaper to go via solar than go the traditional power grid route. Eventually, it will be cheaper, it will be more efficient, and it will make sense for the average common consumer to put solar panels on their roof. And I think Tesla should just hand them out for free. You want solar on your roof? No problem. Here's the unit for free, and then we charge you X amount per month, a little bit cheaper than what it would cost to be on the power grid, and then it makes sense for the common consumer. And I think that's where we're headed. Solar is gonna be $1 trillion business just for the retail side of things. Then you incorporate businesses, county stuff, and it's just gonna be huge business. We also had news today that Tesla is coming out with an ATV for kids. Tesla is starting to sell a $1,900 Cyber Quad ATV for kids. And this just shows where they're headed. They're going to use the automotive side of things as the home base, right? And then they branch out. You got solar. They got this ATV over here. And then who the hell knows what else they're going to be coming out with. We've seen mock-ups of bikes, cell phones. But when you invest in Tesla, you're not just investing in an automotive company. You're investing in so much more than that. And that's what short sellers have gotten wrong for years and years. We've seen some of the biggest hedge funds go belly up because they shorted Tesla. And I definitely am not going to be shorting Tesla stock anytime soon, and we'll be watching for any dip, any weakness to add into. I want to touch base real quick, go back to the big bubble stocks, and we're seeing it happen, the recovery bubble. Think about companies like Peloton. During the beginning stages of the pandemic, Peloton sales and revenue surged because people were locked up at home. We didn't know how this economy was going to evolve, and their numbers went through the roof. People wanted to exercise while they stayed at home. As we open back up, life gets back to normal. Peloton, their numbers, they drop back to where they were prior. So same thing happened with Docusign. Docusign is down huge on the day because during the lockdowns, everybody's working at home. Docusign's numbers, they look better. They were artificially inflated. As people go back to work at the office, their numbers go back to normal. So I think when we're investing, we got to be very careful to look at these numbers and analyze them, and where were they before the pandemic and where are they now? Is it going to continue going up? Are these numbers going to continue going up? Or as we get back to normal life, are they going to revert to the mean? That's something that I'm analyzing before investing in these recovery stocks. We also had Uncle Joe come out today and tout his new corporate tax hike increase. This is something that we need to be cognizant of and continue to watch. If this gets through, if this gets passed, corporations, they're going to figure out a way to make up for the money that they're paying to Uncle Sam, no pun intended. They're going to have to figure out a way to bridge that gap. If they're having to pay $1 billion in taxes that they weren't having to pay last year, you think they're just going to throw up their hands and say, okay, we're going to roll with it. We like to pay taxes. No, they're going to lay people off. They're going to figure out a way to save that money. And that could indeed contract the market as well. So that's going to be something that we need to keep our eyes on. It's very important for the direction of the market. All right, guys, that's going to wrap up this video. I love every single one of you guys. Subscribe, hit that like button. I'll catch you in the next one. Until next time, peace.